xTechnix presents Mastering Portfolio. Diversification, strategies for building a resilient investment portfolio. In the realm of investment, uncertainty is a constant. Markets fluctuate, economies evolve, and unforeseen events can swiftly alter the landscape. In such an environment, the importance of portfolio diversification cannot be overstated. Diversification is a fundamental strategy employed by investors to manage risk and optimize returns. This video delves deep into the concept of portfolio diversification, exploring its significance, various strategies, implementation techniques, and best practices. In the world of investing, the age-old adage, "Don't put all your eggs in one basket," rings truer than ever. This proverb perfectly encapsulates the essence of portfolio diversification, a fundamental strategy for mitigating risk and achieving long-term financial goals. By spreading your investments across various asset classes and sectors, you create a buffer against market fluctuations and the potential downfall of any single security. This comprehensive guide delves into the intricacies of portfolio diversification, equipping you with the knowledge and tools to build a robust and resilient investment portfolio. We'll explore the core principles, delve into various diversification strategies, and shed light on factors to consider when crafting your personalized investment plan. Why diversification matters: unraveling the risk-reward relationship. The primary objective of diversification is to manage risk. The financial markets are inherently volatile, susceptible to unpredictable economic events, political upheavals, and industry-specific downturns. By concentrating your investments in a single company, sector, or asset class, you expose your portfolio to significant risk. If that particular company falters, the entire sector experiences a downturn or interest rates rise. Your portfolio value could suffer a substantial blow. Diversification mitigates this risk by introducing negative correlations. When one asset class experiences a decline, another might rise, offsetting the losses and smoothing out the overall portfolio performance. For instance, during economic recessions, stock prices typically fall. However, government bonds tend to perform well as investors seek safer havens. A diversified portfolio containing both stocks and bonds can navigate such economic turmoil with greater resilience. Beyond risk management, diversification also plays a crucial role in optimizing returns. By strategically allocating your assets across various growth-oriented asset classes, you have the potential to capture returns from different sectors and outperform a portfolio concentrated in a single asset class. Asset allocation. The cornerstone of diversification, the foundation of a diversified portfolio, lies in asset allocation. This refers to the process of dividing your investment capital across different asset classes based on your risk tolerance, investment goals, and time horizon. The primary asset classes include: 1. Stocks represent ownership in companies and offer the potential for high capital appreciation but also carry higher risk. 2. Bonds represent loans to governments or corporations and provide steady income in the form of interest payments. 2. They generally offer lower risk than stocks. 3. Cash and cash equivalents include money market accounts, certificates of deposit, CDs, and savings accounts. 3. They offer minimal risk and immediate liquidity, but also lower returns. 4. Alternative investments encompass a wider range of assets like real estate investment trusts, REITs, commodities, gold, oil, and hedge funds. 4. These can offer diversification benefits but often come with higher risks and fees. The ideal asset allocation for you will depend on your individual circumstances. Younger investors with a longer time horizon can typically tolerate higher risk and allocate a larger portion of their portfolio to stocks. Conversely, investors nearing retirement may prioritize capital preservation and allocate more towards bonds and cash equivalents. Understanding portfolio diversification. At its core, portfolio diversification is the practice of spreading investments across different asset classes, industries, geographic regions, and securities to minimize exposure to any single risk. The rationale behind diversification lies in the concept of correlation. Assets react differently to various market conditions, and by holding a mix of assets with low or negative correlations, investors can cushion the impact of adverse events on their portfolio. The significance of portfolio diversification. Diversification serves multiple purposes within an investment strategy. Risk mitigation. By spreading investments across a diverse range of assets, investors can reduce the impact of individual asset volatility on their overall portfolio performance. Stability. Diversification can enhance portfolio stability by offsetting losses in one asset class with gains in another, thereby smoothing out the overall investment trajectory. Enhanced returns. While the primary aim of diversification is risk reduction, it can also lead to improved returns over the long term by capturing gains from different market segments. Liquidity management. A diversified portfolio can offer better liquidity as investors can access funds from various sources in times of need without disrupting the entire investment strategy. Strategies for portfolio diversification. Asset allocation. Equities. Stocks represent ownership in a company and typically offer high returns, but come with higher volatility. Within equities, diversification can be achieved by investing across sectors, market capitalizations, and regions. Fixed income. Bonds provide regular income and stability to a portfolio. Diversification in fixed income can be achieved by varying bond types, government, corporate, municipal, durations, and credit qualities. Alternatives, including alternative investments such as real estate, commodities, hedge funds, or private equity, can further diversify a portfolio and reduce overall risk exposure. Geographic diversification. 1. Investing in different geographic regions can help mitigate the risk associated with country-specific events, economic cycles, or political instability. 1. International diversification can be achieved through region-specific mutual funds, exchange-traded funds, ETFs, or American Depository Receipts, ADRs. Sector diversification. 1. Allocating investments across different sectors such as technology, healthcare, finance, consumer goods, and energy can mitigate risks associated with sector-specific downturns or industry disruptions. Risk parity strategy. 1. Risk parity aims to balance the risk contribution of each asset class within a portfolio. 1. Instead of allocating assets based on traditional methods like market capitalization or equal weighting, risk parity allocates assets based on their volatility and correlation with other assets. Factor-based diversification. 1. Factor investing involves targeting specific factors such as value, momentum, size, quality, or low volatility within an investment portfolio. 1. By diversifying across these factors, investors aim to capture different sources of returns and reduce overall portfolio risk. Implementing portfolio diversification, assess risk tolerance and investment goals. 1. Before diversifying a portfolio, investors should evaluate their risk tolerance, time horizon, and investment objectives. 1. A thorough understanding of these factors will guide the selection of appropriate diversification strategies. Construct a diversified asset allocation. 1. Based on risk tolerance and investment goals, investors can construct a diversified asset allocation that includes a mix of equities, fixed income, and alternative investments. 1. The allocation should be regularly reviewed and adjusted to maintain the desired level of diversification. Use diversified investment vehicles. 1. Utilize a mix of investment vehicles such as mutual funds, ETFs, individual stocks and bonds, index funds, and managed accounts to achieve diversification across different asset classes and sectors. Regular rebalancing. 1. Periodically rebalance the portfolio to maintain the desired asset allocation. 1. Rebalancing involves selling assets that have performed well and reallocating the proceeds to underperforming assets to bring the portfolio back to its target allocation. Stay informed and stay disciplined. 1. Keep abreast of market trends, economic indicators, and geopolitical events that may impact the portfolio. 1. Avoid emotional reactions to short-term market fluctuations and adhere to the long-term investment strategy. Challenges and considerations over diversification. 1. While diversification is essential, over-diversification can dilute returns and increase complexity without providing significant risk reduction benefits. 1. Investors should strike a balance between diversification and concentration to optimize portfolio performance. Correlation risk. 1. Assets that are thought to be uncorrelated may exhibit higher correlation during periods of market stress, diminishing the effectiveness of diversification. 1. Conducting thorough correlation analysis and stress testing can help identify potential correlation risks. Cost considerations. 1. Diversification can incur additional costs such as management fees, transaction costs, and taxes. 1. Investors should consider the impact of these costs on overall portfolio returns and select cost-effective investment vehicles. Market dynamics. 1. Market dynamics and economic conditions are constantly evolving, which may necessitate adjustments to the diversification strategy. 1. Flexibility and adaptability are essential in responding to changing market environments. Building your diversified portfolio. A step-by-step. Ready to put your diversification knowledge into action? Here's a roadmap to get you started. 1. Assess your risk tolerance. How comfortable are you with potential losses? This will influence your asset allocation. 2. Define your investment goals. Are you saving for retirement, a down payment on a house, or a child's education? Your goals will determine your investment time horizon. 3. Research investment options. Educate yourself on the different asset classes, investment vehicles, individual stocks, mutual funds, ETFs, and their risk-reward profiles. Portfolio diversification is a cornerstone of sound investment strategy, providing investors with the means to manage risk, enhance returns, and navigate uncertain market conditions. By implementing a well-diversified portfolio that encompasses various asset classes, geographic regions, and sectors, investors can build resilience, achieve long-term financial goals, and weather the inevitable storms of the market landscape. While diversification cannot eliminate all risks, it remains a powerful tool for prudent investors seeking to optimize risk-adjusted returns and build wealth over time. Please like, share, and subscribe.